Welcome back to Investing Talk podcast. Today we're tackling a question I know is on a lot of your minds. Is Kodiak Gas Services a good time to buy now? We'll try to unearth the latest insights and data to help you make, a more informed decision, see if this energy infrastructure player is really gearing up, or if there are maybe some hidden currents investors should be aware of. But hey, before we jump into all the numbers, we really love hearing from you. Please remember to subscribe to our show if you haven't already, like this discussion if you find it helpful, and definitely leave us a comment. Your support honestly helps us create more valuable content. And if you enjoy what we do, maybe consider buying us a coffee. The link's usually somewhere below. Plus, and this is important, if there's a specific company you'd like us to look into next time, just drop its name in the comments. We'll add it to our list.
Okay, so let's unpack this. We've got some fresh reports, some analyses on Kodiak Gas Services, company with about a, $2.77 billion market cap, providing really critical energy infrastructure contract compression services.
So we're going to cover their recent, pretty staggering performance, their strategic moves, operational strength, and yeah, the financial health and risks too. Got to cover it all. So the big news, the headline grabber, is Kodiak Gas Services just reported record second quarter earnings. When you look at these results, what really jumps out, what's the most significant thing here?
Well, what's really fascinating, I think, isn't just that the numbers are good, it's the scale of the improvement. It suggests something's really clicking for them. Their net income attributable to common shareholders, it hit $39.5 million. That's 0.43s per diluted share.
Okay, 39.5 million.
Yeah, and compare that to just $6.2 million in the same period last year.
Wow, that's a huge leap.
It's enormous, like a nearly 540% increase year over year. So it's not just growth. It kind of signals they're really leveraging their position,
Yeah.
Turning demand into actual profit. And it's not just the bottom line. Their revenue growth was impressive, too, up 45.4% over the last 12 months.
45%, okay.
Right. And beyond that, they posted a record quarterly adjusted EBITDA that's earnings before interest, taxes, depreciation, and amortization of $178.2 million. That figure is up 15.5% year over year. Pretty robust.
And the margins. I saw something about improved margins, too.
Yes, exactly. And this is key for profitability. Their contract services adjusted gross margin percentage, it improved significantly to 68.3%. Now, that's up 430 basis points from last year.
Okay, 430 basis points. Remind us what that means in plain English.
Sure. So a basis point is just 1/100 of a percent. So 430 basis points is 4.3 percentage points. Basically, for every dollar of service revenue, they're keeping 4.3 cents more in gross profit compared to last year. That's a big efficiency gain.
Got it. That really shows strong cost control or pricing power, maybe both. And it looks like they're not just showing paper profits, but generating actual cash, too, which is always what you want to see.
Absolutely. Critical point. Kodiak generated a record quarterly free cash flow of $70.3 million.
70 million free cash flow.
Yeah, real cash they can use. And they have been using it, returning over $50 million to stockholders just in this quarter. That's through dividends and also share repurchases.
Okay. Return capital.
Exactly. Plus, they offer a pretty attractive dividend yield right now, about 5.7%, which is, quite notable in the current market. Shows confidence, I think.
Yeah, that 5.7% yield is definitely eye-catching, so strong quarter financially. But you mentioned strategic moves. Beyond the earnings, what's happening there? I heard something about share buybacks.
Right, and this connects to that confidence point we were just making. It's a strong signal from management. Kodiak's board approved a big increase to their share repurchase program, another $100 million.
An additional $100 million.
Correct, bringing the total authorization up to $115 million. And they extended the program out to the end of 2026. And they're not just authorizing it, they're acting on it. They've already bought back about 2 million shares, cost them around $60 million, average price just over $30 a share.
So they think their stock is undervalued around that price.
That's usually the signal, yes. And if they complete this whole program, it could shrink their share count by, say, 5 to 7%, which, all else being equal, could boost earnings per share by maybe 6 to 9% annually. It directly adds value for remaining shareholders.
And the timing here seems interesting, too. Didn't they just get added to an index?
Precisely. Good pickup. Kodiak joined the S&P Small Cap 600 Index, effective August 6th, 2025.
Right, the small cap 600.
Yeah. Now, sometimes you get a little short-term price bump from that, maybe 1-3%, just from passive funds having to buy the stock.
Sure, the index fund effect.
Exactly. But the bigger deal, I think, is the long-term legitimacy and visibility it brings. It's like a stamp of approval. It puts them on the radar for a much wider pool of institutional investors. Increases liquidity. The company itself called it a significant milestone. Can't argue with that.
That makes sense. External validation is always good. Any shifts happening inside the company? Leadership changes, maybe?
Actually, yes, a pretty key one. They appointed Stephen L. Green as their chief commercial officer earlier in 2025.
Okay, CCO. What's his background?
Strong track record. He led Pinion Midstream to a very successful exit, $950 million. He's managed billions in capital before, and his expertise is right in their wheelhouse, scaling midstream assets. That's Kodiak's core business.
Right, the compression services.
Exactly. And importantly, his focus is apparently on securing more fixed revenue contracts with, top-tier producers. The goal there is to reduce volatility, the ups and downs tied to energy prices, and just bring more discipline to how they use their capital. Seems like a smart hire.
Okay, so strong financials, strategic buybacks, index inclusion, new commercial leadership focused on stability. Sounds like a lot is going right. How does this translate operationally? What's the story with their actual equipment, their fleet, and how they stack up against competitors?
Yeah, the operational side really backs up the financials. Their fleet utilization hit 97.2%.
97%. That's
Ah.
incredibly high for heavy equipment, isn't it?
It really is. Almost running flat out. It tells you demand for their services is just sky high. And it also says a lot about how well they maintain their gear. That's up 2.9 percentage points from last year, by the way.
Wow.
They also put nearly 32,000 horsepower of new large compression units into service. So they're investing back into the fleet too.
And where are they operating mostly?
Heavily in the Permian Basin, also other major U.S. basins. These are the places where the action is, especially for the large horsepower units they specialize in. Demand is just very, very strong there. Think of them as providing the essential muscle, the pumps, to move natural gas through the pipeline system. It's critical infrastructure. Not many can do it at their scale.
So that scale gives them an edge. How do they differentiate?
Big time. They're positioned as a market leader. Their size and the fact they offer these large, complex units gives them, pricing power. And their business model, often using long-term contracts, provides stability that smaller competitors just can't match. They're providing something essential in a market where they have significant advantages.
And I remember seeing something about an environmental angle, ESG. How significant is that for them?
It seems quite significant, actually, and potentially a real differentiator, not just, greenwashing. They describe their fleet as the newest and most emission-friendly in the industry.
Okay, newest and most emission-friendly. What does that mean practically?
It means they're investing in compression technology that leaks less methane, it's more fuel efficient, reduces flaring. Basically, it helps their customers meet their environmental targets.
Ah, so it's a selling point for their customers too.
Exactly. As regulations tighten and investors focus more on emissions, offering a cleaner solution becomes a competitive advantage. It helps them navigate those headwinds. They even won an ESG award from Hard Energy back in 2021. So it seems to be a genuine part of their strategy. Helps future-proof the business, potentially.
That's a smart angle. Okay, so operations look strong, strategy seems sound. Let's check the financial foundations again. You mentioned debt earlier. How does that balance sheet really look?
Right, it's important to look at the whole picture. They did pay down about $48 million in debt in the quarter, which is good progress.
Okay.
But the total debt outstanding was still $2.6 billion as of June 30th, 2025.
2.6 billion. That sounds like a lot relative to their market cap.
It is a significant number. Their debt-to-equity ratio is 1.98, so almost twice as much debt as equity.
Is that typical for this kind of business?
For capital-intensive infrastructure businesses, higher debt levels aren't uncommon, especially if cash flows are strong and stable, which Kodiak seem to be. But it's definitely something to monitor. Their leverage ratio, which compares debt to their adjusted EBITDA, is reported at 3.7x.
3.7 times. What's the comfort level there?
It's sort of in the moderate range for the sector, not screaming red flag, but it's leverage. It adds risk. Investors need to weigh that against their ability to keep funding everything, the fleet upgrades, the ESG initiatives, and returning capital to shareholders via dividends and buybacks. It's a balancing act.
Right, especially if interest rates stay high or go higher.
Exactly. That said, analysts generally rate their overall financial health score as good. Their growth and profitability scores are particularly strong, which helps offset the leverage concerns somewhat.
Okay, so manageable, but definitely something to keep an eye on. What are the analysts saying overall? What's the consensus view on the stock and the valuation?
The sentiment is largely positive. Most analysts rate Kodiak as either a strong buy or a moderate buy. I think the count was something like over 9 buys and only 1 hold rating, so pretty strong agreement there.
Okay. And the stock price itself, where is it trading now versus where analysts think it should be?
Right, so as of mid-August 2025, the stock was trading around $35.12 per share.
$35.
Yeah, but the analyst consensus price targets are quite a bit higher, generally clustering between $41.10 and $41.50.
So they see upside.
Quite a bit, yeah. That implies potential upside of around 18 to 19% over the next year or so. It suggests analysts feel the current market price doesn't fully reflect the company's growth, those strong margins we talked about, and the cash generation. They see it as fair to maybe slightly undervalued.
Interesting. 18 to 19% potential upside is nothing to sneeze at. But of course, no investment is risk-free. What are the potential bumps in the road for Kodiak?
Absolutely. Got to consider the risks. The whole energy sector is inherently complex, right?
Always.
So for Kodiak specifically, risks include, as we touched on, it's a high capital intensity business, needs constant feeding to maintain and grow that fleet, exposure to oil and gas price cycles, even with contracts. A major downturn eventually impacts demand for their services.
Reliance on key customers, too, probably.
Yes, concentration risk is always there in this sector. If a major customer cuts back, it hurts. Then there's broader sector volatility, commodity prices, regulatory changes around emissions are a constant potential threat, the whole energy transition dynamic.
And interest rates, you mentioned.
And interest rates, definitely. Higher rates make that debt load more expensive to service for leveraged companies like Kodiak.
Okay, so a fair number of risks, typical for the sector, that important. What about potential positive catalysts? What could push the stock higher?
Well, several things. Short term, you'll watch their next earnings report. Any updates to guidance, continued execution of the buyback program, maybe even another dividend increase, those could all be positive signals.
Right, near-term performance markers.
Exactly. Longer term, continued expansion in those key basins like the Permian is a big one, winning major new contracts, and just successfully navigating those bigger macro shifts in natural gas demand and the clean energy transition. If they do that well, that builds long-term value. Oh, and don't forget potential M&A.
Mergers and acquisitions.
Yeah. Kodiak, with its market position, could be an attractive target for a larger player. Or they might make acquisitions themselves to grow faster or enter new areas. That could definitely move the needle.
Okay, so we've covered a lot of ground-strong performance, strategic moves, operational muscle, the financial picture with that debt, and the risks and catalysts. So, boiling it all down, what does this mean for you, the listener, considering Kodiak Gas Services? Well, it seems Kodiak definitely has strong fundamentals going for it. Growing revenue, those record margins, super high fleet utilization, and management seems focused on returning cash to shareholders through buybacks and that nice dividend. Plus, their leading position in a pretty critical infrastructure niche gives them some defensibility, you'd think.
I think that's a fair summary. The investment case seems to be essentially a bet on their resilience and their operational skill in a vital sector that's also, changing. The volatility and the capital needs are real risks, no doubt. But the current valuation does look attractive compared to their growth prospects, especially with analysts seeing that potential 18–19% upside. So for investors with maybe a medium to long-term view, their ability to juggle those shareholder returns with operational needs and that ESG focus makes them, well, an intriguing company in this evolving energy space.
And as always, it comes down to balancing these points, the good, the bad, the potential, against your own personal comfort level with risk and your investment goals. It's never one size fits all.
Which leads to maybe a final question for you to think about. How will that ongoing tension, the world needing more energy but also demanding cleaner solutions, ultimately shape the future value of companies like Kodiak that provide this essential gas infrastructure? It's a complex dynamic, that's for sure.
A very important question indeed. We hope this discussion has given you a clearer picture of Kodiak Gas Services. Join us next time for another exploration into the markets.